We're always looking for ways to maximise our investment returns, which was how we first came to design what we call the Money Unshackled Spread Betting portfolio, which utilises up to 3 times leverage to find a balance between mega returns and risk. The problem with using leverage is that when things go bad, you can get wiped out, which is a bit of a drawback. I'm sure you'd agree.
We truly believe that our spread betting index futures strategy is a game changer and will enable us to retire richer and far sooner than if we just stick to bog standard index investing. For this reason, we are both confident investing tens of thousands of pounds into the spread betting futures portfolio and will continue investing in it for years to come.
One major drawback is that it's complicated, and we're not exaggerating when we say that. It's ridiculously complex for casual investors. Some people who've watched our videos, who like the idea but are probably looking for an easier alternative, have asked us about using 3 times leveraged ETFs instead. However, this is a very different strategy and will produce different results. Anyone who may have researched long-term investing using 3 times leveraged ETFs may have come across a strategy put forward by somebody known as Hedgefundie on the forum bogleheads.org.
In this video, we're going to explain what Hedgefundie's 3 times leveraged ETF strategy is, how you can do it in the UK, how it compares to the Money Unshackled Spread Betting futures strategy, and what we're both doing going forward. Let's check it out.
If you've previously been interested in our spread betting futures portfolio but found it too complicated, then we've come up with a solution that makes it as easy as pie. This will also help those of you who are already doing it to streamline the entire process and will help you to cut out mistakes that could cost you big time.
We've gone ahead and created an easy-to-use Excel model that clearly tells you what spread bets you need to place, that factors in your existing portfolio, desired leverage, target portfolio, and more. We ourselves use this spreadsheet every time we invest using futures. We'll link to this down below, and if you use the code on screen now, you can get 40% off, but be quick as this offer won't last long. You need to tread carefully. It should go without saying that both of these strategies are super high risk, and you can lose all your money. If you go into this without knowing what you're doing, then it will be even more likely that you get burned. When spread betting, around 70% of clients lose money, but not necessarily with this strategy, and leveraged ETFs are often touted as not appropriate for long-term investing and should only be used for short-term trading. You could say that the consensus is to avoid using leverage long-term. Some people like us disagree when it's used carefully.
What is the Hedgefundie strategy? Hedgefundie created a thread on website bogleheads.org in February 2019 proposing a 3 times leveraged ETF investing strategy. It's based on risk parity using the S&P 500 index and long-term treasury bonds held in a 40-60 allocation and rebalancing quarterly. He later updated this allocation to 55-45. For the original 40-60 allocation, the simulated backtesting showed that $100,000 turned into $14 million from 1987 to 2018, a 16.7% compound annual growth rate. This absolutely smashed the return of an unleveraged S&P 500 tracker, whose final balance was just $2 million, or 7 times less.
The ETFs used to achieve this are UPRO for 3 times S&P 500 and TMF for 3 times long-term US Treasury bonds. Both of these are US listed, so UK investors will have to substitute with ETFs available to us, which we'll get to later in the video. Extensive backtesting, discussion and analysis supports the validity and potential market outperformance of the strategy. The original thread has over 3,300 posts and the follow-up thread has over 12,500 posts, so it might take you a little while to read through, but we'll put links in the description for those interested.
Hedgefundie's 3 times leveraged ETF strategy relies on the uncorrelated relationship between the S&P 500 and long-term US Treasury bonds. The hope is that when stocks fall, bonds will come to the rescue. Consider it the portfolio insurance. We ourselves did some very basic backtesting of this relationship from 1978 and found that every year stocks fell, long-term bonds did indeed produce a positive return, except on 2 occasions. In 2018, both stocks and bonds had a small negative return, and in 2022 year to date, both stocks and bonds are collectively being hammered.
Life-changing returns. Because both UPRO and TMF were born in 2009, all the extensive backtesting was carried out on simulated data by Hedgefundie. We wanted to also see what the actual results were for these ETFs, and here it is going back to the start of 2010, right up until April 2022, for both of Hedgefundie's asset allocations. For the 55 to 45 portfolio, despite massive losses so far in 2022, a small investment of $10,000 transformed into $216,000 and even reached $378,000 at its peak at the end of 2021. The major problem is of course the volatility and the potential for enormous drawdowns. That's the largest fall from top to bottom. The max drawdown is currently 43%, and we would say, based on current market sentiment, that this could get far worse. For those that can handle enormous potential drawdowns, this 3 times leverage strategy could be a roller coaster that makes you very wealthy.
How to do this leveraged ETF strategy in the UK? WisdomTree is the only ETF provider, as far as we know, that has anything close to what we need. The WisdomTree S&P 500 3 times daily leveraged ETF, ticker 3LUS, should be a direct replacement for UPRO. Both do the same thing. In fact, the WisdomTree ETF is actually slightly cheaper.
A big problem for UK investors is that we don't have an exact alternative to TMF. TMF gets exposure to long-term treasury bonds over 20 years, but the closest we have is the WisdomTree US Treasuries 10-year 3 times daily leveraged ETF, ticker 3TYL. As this is an intermediate bond ETF, it won't be as volatile as longer-term bonds, and therefore the theory states it won't counteract the downward movement of stocks as well.
Using an equivalent 3 times US 10-year ETF, ticker TYD, as a substitute, we ran a backtest to see what would have happened. We're using the US ETFs for the backtesting because they've been around longer than the UK versions and should still provide similar returns.
Starting with $10,000, the final balance of $149,000 was much lower using the intermediate bonds than what it had been using the long-term bonds at $216,000, but the volatility was less, and so was the max drawdown. Intermediate bonds are less sensitive to interest rate changes, which could actually be a blessing in today's world, as interest rates could be rising a lot. Our gut feeling is, if we ran this backtest later in 2022, the intermediate bond portfolio will be doing better than the portfolio containing the long-term bonds.
You'll be able to invest in these ETFs with the major platforms, like Interactive Investor, but as they are complex instruments aimed at sophisticated investors, you will probably have to complete an appropriateness test to confirm their suitability. A major problem you might face is the high share price of the WisdomTree S&P 500 3 times daily leveraged ETF. At time of filming, one share costs £900, which will make building a balanced portfolio very difficult on smaller investments.
The only free trading platform that we know that offers both ETFs is Trading212, and they are available in fractions, so they might be your only option. Due to the potentially massive profits, you probably want to buy these in a tax-sheltered account like a stocks and shares ISA or a SIP.
But what about volatility decay? Whenever we've mentioned leverage previously, someone inevitably starts to cry about volatility decay and stating that you can't use this type of leverage for long-term investing, even though the backtesting proves otherwise. We don't have time in this video to explain what volatility decay is, but as Hedgefundie states, if an index tends to go up over time, i.e. exhibits positive momentum, a 3 times leveraged ETF would tend to perform better than 3 times the index over the long term. Because we expect the market to rise over time, we would expect to benefit from volatility decay rather than lose out to it, but it is a risk nonetheless, and you should read up on it before proceeding.
Why not 100% 3 times S&P 500? With 3 times leveraged ETFs, you can't get a margin call or have your position closed as with other margin investing. So theoretically, you could simply hold the 3 times S&P 500 ETF until it recovers from any losses, and eventually it might generate big returns. However, during a deep market crash, the drawdown would be so severe that it would take decades to recover, and at one point the loss was almost 98%. Hedgefundie demonstrated this in this backtest, where the red line is the 100% 3 times S&P 500. It took almost 20 years to recover after the crash in 2000. A 3 times S&P 500 ETF might be a useful tool on its own to trade after a big market crash, but as a long-term investment, we can't imagine many people will be happy to wait 20 years to only get their money back, with considerable risk throughout.
How does Hedgefundie's 3 times ETF strategy compare with 3 times spread betting futures? As a quick recap, our strategy involves using a spread betting account to invest in S&P 500 futures, long-term US Treasury futures and gold futures in a 60-30-10 ratio. This was specifically chosen because, historically, for this mix of unleveraged assets, the largest ever drawdown was less than 30%.
A benefit of spread betting over leveraged ETFs is you can control the amount of leverage you use simply by depositing more or less money. Generally, 3 times leverage is the maximum we would want to use, but hypothetically, if the market had created 50%, we might want to use a little more. Or conversely, as we age, we want the ability to reduce leverage as a way to de-risk.
Another benefit of going down the spread betting route is that you remove all the exchange rate risk. If the S&P 500 went up 300 points and you had a bet of £10 per point, you made £3,000. But with the ETFs, if the exchange rate moved against you, your gain on the S&P could even be a loss depending on the size and direction of the exchange rate movements.
With the ETFs, the leverage is reset daily, so after a period of losses, getting back to the starting point is much harder. Whereas with our spread betting strategy, we are allowing the leverage to increase as the market falls, because getting back to the starting point is easier this way. In this example, the market has fallen by 10% in a day. With the spread betting portfolio, the market only needs to recover 11.1% to get back to square one, but with the 3 times ETFs, the market would need to recover 14.3%. The ETFs have minimised future risk by resetting, but as a side effect, recovering is harder.
Currently, both strategies can be tax-free. Spread betting is tax-free as it's classed as gambling, and the ETFs can be bought within an ISA or a SIP. There are no rumours to suggest the following would happen, but you could imagine a future government changing the tax rules regarding spread betting, although this is probably unlikely as more people lose money than profit from it. If spread betting became taxable, then the losses would be tax deductible, so the government would suffer. But nevertheless, it does feel a little safer from a tax perspective having the money stashed away within a mainstream account such as an ISA, but that could just be me.
A potential risk of our spread betting strategy is that if a market crashed severely and the spread betting platform simultaneously raised the margin requirement, you might find yourself with a margin call. Our educated guess is that the likelihood of this happening is slim, as we're sticking to major instruments like the S&P 500, but it could happen. With the leveraged ETFs, this wouldn't be possible, so it's one less thing to worry about.
One benefit the leveraged ETFs have is potential for greater gains during a fast-moving bull run when the leverage is starting at the same 3 times. With the spread betting, as the market moves up, our leverage is reduced and we're only resetting at 3 times every so often, perhaps monthly or even longer. This means we capture less leverage gains.
Conversely, the ETFs reset leverage daily, so could surge in a rapidly increasing market. This chart shows our 3 times S&P 500 ETF in orange, from about the low point in March 2020, which was the COVID crash. The blue line is just the standard S&P 500 for comparison. Your timing would have to be exemplary for this exact scenario, but this at least shows how rapidly a 3 times S&P 500 ETF can rise.
What are we doing? There's no doubt about it, we will both be continuing to invest heavily into the futures spread betting portfolio. Since we've built and improved the Excel model we mentioned earlier, it has made our spread betting strategy much easier. If you want to purchase your copy, then we'll link to that down below. We think if it keeps you from making even one mistake, it pays for itself. As for the leveraged ETFs, there is a much bigger risk of permanent losses if you end up buying when prices are too high, but if market prices keep falling as they have done recently, then we both may be tempted to jump in with 10 grand or so if the market was down by more than 30% and hold for the long term from that point on.
Question of the day: what are your views on using leverage to invest? Have you considered any of these strategies? Join the conversation in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.